Yes, well, we believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are, we see an inverted yield curve, and that, of course, is also a warning sign. I think our point of view is that this is going to be a severe inventory recession.
Hey guys, welcome back to the channel. Today we have Cathie Wood on what's coming into the market this year. Wood believes the Fed rates will decrease by the start of next year because the economy is showing signs of extreme weakness. The household employment charts have been down for the last 4 months, and Wood has never seen a swifter increase of the bottom. Many people haven't realized we've gone up about 50% from the previous lows. There have also been many layoffs from companies everywhere. Wood believes that all this is associated with the giant inventory glut currently taking place. Let's listen to this interview with Cathie Wood as she gives her take on deflation and the future of the financial market. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Cathie, the key debate on Wall Street, what everyone is discussing is the Fed going to continue hiking rates, or are they going to stop and turn around to come back down next year? What do you think?
We think the latter. We're getting all kinds of signals that the economy is very weak. I know a lot of people are focusing on last week's big employment gain in non-farm payrolls. But if you look at household employment, which is a much broader based survey of employment, that has been flat to down for the last 4 months. If you look at claims, we've never seen a faster increase off the bottom than we've just seen. We're up about roughly 50% from the lows. Many people, I don't think, have taken a close look at that. And we're hearing one layoff after another. And we know the Challenger survey says that layoffs are up 55 to 60% year over year. And I think this is all related to inventories. We have a massive inventory glut. And so I think that the last few hires, I think companies were really happy to get them because labor was in short supply for so long. But I think that
now there's an inventory
going to see the unwinding.
Wood believes that there is a lot of evidence that the real problem in our economy is actually deflation. The CPI and PPI are both lagging indicators, which means the Fed is always driving policy away from them. Wood says the real inflation index is gold. Since its peak in August 2020, we've been in the low end of the trading range. Wood believes that if the Fed continues constricting, the dollar will begin to increase and commodities will keep falling.
On Bloomberg TV, we're talking with Ed Ludlow out of Bentonville, Arkansas, and you said to him, we have a real inventory problem. Walmart and Target had just been out with numbers that were concerning in terms of the buildup of product, and you said deflation is more of a concern than inflation. Do you still think that after the big prints that we've seen, and we're still expecting, for example, 8.7% headline CPI on Wednesday?
Yes, I still think that because the evidence is piling up. Now, the CPI and in some measure, the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If I look at Dr. Copper, the commodity with the PhD, it had been trading for a year in the $4 to $5 per pound range. It's now down to $3.50. It's had a decisive break. And if you look at how that's going to feed into the indexes, it'll feed in slowly, to be sure. But just month over month, copper is down roughly 20%. And year over year, it's down roughly 20%. So that's the activity side of things. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020, 2 years ago. And we've been in a trading range, to be sure. We're at the low end of that trading range now.
Right.
If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall.
Big debate right now is whether we're currently in a recession. Obviously, it's up to the NBER to officially declare that, but curious to hear your take on where we are currently.
Yes, well, we believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are, we see an inverted yield curve, and that, of course, is also a warning sign. I think our point of view is that this is going to be a severe inventory recession, but we didn't have the systemic excesses like we did pre-08-09 in the mortgage market. So it's an inventory recession here. And while most economists are saying, oh, okay, the inverted yield curve points to a recession maybe next year, we believe we'll be coming out of it next year. Now, I think the big question is what's going on in China. I think some of the commodity price decline has to do with China unraveling in some sense from a cyclical point of view. I mean, they've got their foot on the brake in many ways. They're trying to let it off a little bit here and there. But I think that the real estate downturn in China is 30% of their economy, 75% of consumer savings. I think they're not going to be able to control it the way they thought they were.
If you believe we're in a recession and you believe the Fed is going to go on a sort of hike-raising path, why not go to cash? Why stick into the fund? It's an actively managed ETF. You can do whatever you want. And I guess some people wonder why not have more of a cash reserve?
We are going to be 100% invested in innovation. That's who we are. This is what we're paid to do. This is what we say we are. And we think that innovation is going to be a critical allocation in the years ahead as the world moves rapidly. And it tends to, innovation tends to gain traction during tough times. Innovation solves problems. We have so many problems right now. We've got the supply chain problems, which we're still hearing about. We've got energy and food prices up because of the war, really hurting consumer purchasing power. And so I think better, cheaper, faster, more productive, more efficient, more creative is going to win. That's what innovation is. So we think most asset allocators are short innovation. And I don't mean NASDAQ 100. We don't think that's truly disruptive innovation. We believe that our ARC is more the old style NASDAQ than the NASDAQ is today, because that's all we focus on. If our outlook for deflation is correct, cyclical deflation and secular deflation, secular deflation associated with technologically enabled innovations. That's a good deflation. That's not a bad deflation. If those two are correct, that would be the best environment.
Wood believes that we are currently moving into a serious inventory recession. The only difference is we don't have access to the systematic excesses like in the pre-08-09 mortgage market. Wood states that the ongoing decline is partly due to China beginning to unwind from the cyclical point of view. Wood says that ARK Invest will be completely invested in innovation, and in the coming years, it will be an essential allocation. Innovation always builds up traction during hard times because it always solves problems. If Wood's interpretation of deflation as cyclical and secular is correct, this coming deflation will actually be a good environment for the financial market's growth. What do you guys think about Cathie Wood's opinion on deflation being good for the economy? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.